Today's topic, I want to discuss in full detail longevity insurance. And most importantly, how can longevity insurance help get you to your dream retirement? Looking underneath the hood at the good, the bad, the ugly, when is longevity insurance a good thing? When is it an absolute nightmare? When should you avoid the landmines? And then how can you use it like an individual tool in a tool belt based on what sort of retirement accounts you have? How can you leverage it for retirement peace of mind, for retirement bliss? And really, if you're super stressed about going into retirement, nearing retirement, whether you're 10, 5 years, 2 years, or currently retired, if you're stressed that you're going to outlive your retirement savings, longevity insurance could really help. If you're stressed that downward market losses could really impact your accounts and force you to start working later on in life, this could help you. If you're stressed that you just don't want to, reduce your style of living and you're spending money a specific way, and you want to make sure that you're maintaining that lifestyle when you do hit your ideal retirement date, that's where this could help. And most importantly, when you have a proper longevity insurance plan, it could allow you to stop working as quickly as possible with the smallest amount of effort and using the smallest amount of dollars. So all those are obviously positive things. This video is not for an individual that's more, risky and more risk tolerant, that wants to really, deal with the ebbs and flows of the market. That's not what this is for. This is more for the safe individual, the individual that says, you know what, I want a bird in the hand. I want to make sure that if I'm giving X amount of dollars into this account, that it's going to give me X amount of benefit. And I want to avoid those common mistakes. I do not want to add more dollars than what's necessary into those specific plans, but the smallest dollars, so that I'm able to hoard the most amount of money, leftover money, in my pocket for emergency needs, for growth needs, for vacation funds, for inheritance maximization, whatever the case might be. So let's get started. Whenever you're reviewing the different topics we're covering, make sure to have as the forefront my dream retirement. What's the retirement that I envision? What exactly does that look like? And then when we're going over what a longevity insurance plan is, what are some of the problems with it? What are some of the solutions? If that correlates to something that could make your dream retirement a reality, then obviously it makes sense to move forward with one of those plans. And there's going to be a lot of different information in this. At any point in time, if you would like to speak further about this, you could simply call our 1-800 number up on the screen. It's 1-800-566-1002. You could visit our website at fosseyfinancial.com, or you could click on the calendar link that's embedded in the description of this video. So in its most basic components, longevity insurance is the opposite of life insurance. Life insurance protects an individual from dying too soon, or protects that individual's beneficiaries, their family, from dying too soon. So if you have a random example, let's say you have a farmer and he's 40 years old and he has his wife, his kids, and this farmer unfortunately gets run over by a tractor, but he had life insurance. If let's say he had a life insurance policy for $100,000, he gets killed, had the policy was in force, that $100,000, because he did not live the life that he was supposed to, however long he was supposed to, that $100,000 got paid over to the beneficiaries, to his wife, and now his wife was able to take those dollars and then act as if he's still living, use those income streams or that lump sum to basically, help out for those different expenses. Longevity insurance is the complete opposite of that. Longevity insurance still has to be offered through an insurance company, and it uses something called mortality credits, produces a lifetime income stream for an individual when you give the insurance company a lump sum of dollars. So these plans could get set up with non-qualified monies like savings, savings checking account. You sold a house, sold a business, whatever that is. You use those sorts of dollars for this. You could use it from IRA money. So let's say if you had a 401k and you're eligible to roll that money over into an IRA, you could have it in an IRA that's customized for this sort of longevity insurance play. Same thing with Roth IRA. Let's say you have a Roth 401k or Roth IRA account and you want to customize it into a custom Roth IRA with this lifetime income stream. You could do that as well. So there's a slew of different ways on how you could set them up. But ultimately what it's doing is protecting that individual from living too long. And so if you had that example where let's say this person is 60 years old and they give $100,000 to whatever the top option is, let's call it company XYZ. Company XYZ is going to calculate, okay, this male, age 60, married, they should be living maybe until age 80, as an example, just a hypothetical example. They're going to take those mortality credits, however long that individual is going to live, and the law of large numbers to say, okay, with this premium, we understand that if we're calculating that this person's going to live about 20 years, we could take this 100,000 and say, okay, if he had it in a bucket, he'd be able to sift off about $5,000 of that bucket each year for the next 20 years. So we're going to give this individual incentive. Rather than just go and take his money and invest in himself, putting in his checking savings account, whatever that is, if he gives it to us, we could guarantee this person $7,000 as a hypothetical example, lifetime income for the rest of his life. So this individual is thinking, okay, well, I could either try to do it on my own, or I could use an insurance company, use the law of large numbers, use mortality credits, and be able to at least have this bird in the hand, this $7,000 lifetime income payment, or 7% cash flow. So if he puts $200,000, he knows he's going to get $14,000 back. If he puts $300,000, he's going to get $21,000 back in that example. Now, where this gets a little bit dicey, and this is what explains the generic concept of an annuity. That's ultimately what longevity insurance is. It's a marketing term for an annuity. The problem is there's so many different types out there, and there's so much bullshit out there that individuals constantly get caught up in the smoke and mirrors. They get caught up in the marketing messages in the wrong trap. So you might have company XYZ that's giving this person $7,000 of cash flow per $100,000 that he's depositing, versus another company that's only giving him $4,000 because they had a nice marketing message and they were on different TV commercials and they were explaining, oh, lifetime income, you can never outlive it. Yes, both things are true, but by not looking underneath the hood on what's the best solution, that individual is losing an extra 3% of cash flow from his $100,000 by going with the superior product as opposed to the inferior product. I'm going to show you how to ultimately back up into the math, but the first step is figuring out whether or not it makes mathematical sense to leverage this sort of account. For an individual that says, you know what, I'm pretty healthy, I have time on my side, I want to plan as if I'm going to live to 100 years old, 90 years old, 80 years old. I do not want income to stop at any point. That's where this could make sense. For the other individual, let's say that, they're in their 50s, they're in their 60s, and they've had massive heart attacks, massive strokes. They do not have time horizon on their family history. That's where maybe, this might not make the most mathematical sense. So once again, the generic concept of it is instead of taking on the risk yourself, you could use an insurance company to take on that risk. Now, rather than go into old-fashioned annuities with annuitization, there's certain things you could do to get a higher payout, and whatever you don't use up, leave those dollars to your beneficiary. So you're ultimately able to have your cake and eat it too, able to have lifetime income. That was the main purpose for it. And if you pass away prematurely, you at least have an account balance that's getting left over to your beneficiaries, so you could ultimately have it like a win-win. Let me delve further into this, going over the problems, and then I'll go over different solutions on how you could delegate your retirement funds using the smallest dollars and only as much as necessary towards these specific intervals to stagger them up properly so that when you hit your ideal retirement date, you never have to worry about outliving your savings. You never have to worry about downward market losses, hurting your portfolios, hurting your chance of success. You never have to worry about reducing your lifestyle once you hit your ideal retirement date, saying, I'm spending money a specific way. I want to make sure that I'm not dropping off that much. This is the way I've always spent money for the last 10, 20 years. It's going to be really hard for me to reduce my lifestyle. So I want to make sure that I have some sort of, baseline of expenses that are being covered by utilizing this specific tool. And then most importantly, this helps individuals stop working and start living the retirement that they've envisioned as quickly as possible with that smallest amount of effort. So what are some of the problems with this? The first problem is not understanding your current retirement situation. If you're nearing retirement or you're in retirement and your income streams are already covered, let's say that you have pension income, you have Social Security income, let's say you have multiple rental properties, and the different income sources that are coming to you for both you or you and your spouse is greater than or equal to what your expenses are, well, why would you try to add on an additional income play to your current situation or to your projected retirement situation? It wouldn't make any sense. And this is where a lot of the bullshit marketing messages essentially come into play, is individuals get suckered into some of these product lines that have income riders thinking that it's a pure guarantee on their actual money, and it's not. So if they hear something like a 7% roll-up, the way an advisor will wrongfully explain that to the individuals. Oh, you're going to have a guarantee of 7% on your money, 7% on your money. So that person says, wow, if interest rates are, paying fixed at 5%, but I'm able to get 7% or 10%, this is amazing. This is what the advisor told me. And it was a wrong play. Only get interested in income-related products if you have an income-related need. So as an example, one way to create these things is if when you're doing your inventory on what your cash flows are for both you or you and your spouse, what is that number? Is that lifetime income that you could rely on those cash flows? And then when you're doing a Rolodex of what your expenses are, your expenses right now, what your expenses are projected to be when you paint your ideal retirement picture, do those two things match? Is your income greater than or equal to your expenses? Because if your expenses exceed what your income is, what your at least lifetime income stream is, well then that's a gap. There's a gap there. There's some sort of problem. What happens if you don't fill up that gap or you don't fix that gap? Well, the first downward market loss that occurs is going to produce extreme financial stress to your specific situation. You're going to constantly be relying on the growth of accounts as opposed to leveraging your accounts, leveraging the accounts you've already built in a safe way to trigger certain income streams. So the first thing is, if you don't need extra income, don't use an income-related solution. Just like if you don't need extra growth or you don't need extra risk, why would you leverage risky-related solutions, risky growth-related solutions? Each one should be optimized towards its specific lane. The secondary component is there's so many options available, it's hard to distinguish which one is good versus which one is bad. And whenever you're looking at lifetime income, you want to look at a slew of different options and say, okay, if I gave a single dollar to this company, which sort of cash flow percentage am I getting out in return? So as that $100,000 example, if you have one company that, let's say you have an individual that's 60 years old and they want to retire at age 65, and you go through the gamut of what your options are based on your state, based on if it's going to be single life, joint life, whatever that is, and you have company ABC, when you give $100,000 at age 65, waiting 5 years to therefore trigger your lifetime income stream, if company ABC is giving you $8,000 per year versus company XYZ is giving you $12,000 per year for that same $100,000 deposit, you would be shooting yourself in the foot by going with that move. You're getting a significantly higher lifetime income stream using the same amount of dollars, but by taking a step back and realizing this is a superior option versus inferior option. And many times it's not the individual's fault. It's mainly the advisor that's just trying to sell one company or peddle one sort of product, and they're trying to fit a square peg in a round hole. And that's not how it should be created. You should always make sure that what is your actual goal, what is the income that you need, and then back up into the math. If you understand that one company is going to give you $12,000 for a $100,000 deposit, well, that tells you that's 12% cash flow. Any dollar you're putting in will generate some sort of 12% cash flow from that superior product. Versus the other inferior option, for every $100,000 I'm putting in, it's only giving me $8,000. That's an 8% cash flow. So by backing up into the math, if somebody has a $20,000 gap, take $20,000 divided by 12%. That's how much is the smallest dollars and only as much as necessary to place into that specific type of account. And obviously taxes come into play, because if you have a traditional IRA account that you're creating with this sort of longevity insurance account, or you're leveraging a Roth IRA account, well, the Roth IRA, you could put less dollars in there because you don't have to worry about those taxes versus a traditional IRA. If, let's say, you need to withhold an extra 20% for taxes for the end of that year, well, then that means you need to take 20% more to net out the same amount that you would have with that Roth IRA. So there's some, obviously more detailed components to it, but just be mindful. Always go with the superior solution. Always make sure that you're putting it through the whole slew of options, not just one, two. One of the things that we do very well on a national basis is we leverage every carrier out there. There's hundreds and hundreds of different options available. You have there's annuitization options, which I don't like. Variable annuity options, which I don't like because they're very expensive. The lifetime income stream for variable annuity options are not as high as some of the fixed or fixed index solutions with income riders to it that allows you to have that flexibility of I'm going to trigger lifetime income. It's the income exactly what I need to be confident, to live my retirement with confidence and bliss and without financial stress. But if I pass away prematurely, I at least have a death benefit that's going to get left over to beneficiaries. And let me kind of hone into that part, because if, let's say, you go into an annuitization option, like old-fashioned annuities versus the income rider solution, why am I tilting it towards the income rider solution? Like, what would be the difference of that? And some individuals like the annuitization. Some individuals like the income rider solution. I like the income rider solution because I believe that there's more get out options, and the more flexibility, the more options somebody has, the better it is for their retirement needs in case something, deviates them off their path, whether a death, whether a disability, whether they just, they have to make a move. Maybe there's a higher inflation than anticipated, whatever that case is, but you want to be able to dart into certain areas and have that flexibility to do so, which annuitization options do not allow you to do so. So what do I mean by those differences? And a very basic example to explain the difference between annuitization versus income riders and triggering lifetime income that way would be, let's say if you have a DIA, deferred income annuity, which is leveraging annuitization options, and same situation as before. You have a male age 60 looking to trigger income at age 65. Let's say this individual gives $100,000 to the company, to whatever the top option is through a DIA, deferred income annuity option. If you're triggering a life-only option, what's going to happen is you're going to have lifetime income, but that income is ultimately going to stop, obviously, when that individual passes away. And if there's no period certain with it, and the guy's living, and then passes away, there's no money left over to beneficiaries. Versus an income rider option, same thing. They put, at age 60, puts $100,000 in, waits till age 65. He's able to trigger income, but through an income rider. He's living, he's taking out income. If he lives to 120 years old, he has lifetime income, just like annuitization. But the difference is, if he passes away prematurely, if there's still an account balance that's sitting there, there's always an account balance with an income rider. So it's a fixed index annuity. Your physical money grows when the index increases, gains 0% whenever the index goes down. If you tack on an income rider, you have the same mechanism working with your physical money of growth when it goes up, doesn't lose when it goes down. But whenever you start taking out income, it's going to reduce your account balance proportionately. And if you also have an income rider fee, that's going to reduce your account balance proportionally, whatever the cost of the fee is. But what happens is it still allows your account to grow. So if you took out $10,000 because that's what your lifetime income stream number was from the income rider, but your account gained $12,000, you would have been able to net that extra $2,000 extra into your account. So when you're fast forwarding that, whenever you pass away, you're now able to leave that larger bucket to your beneficiaries. What we've seen is whenever you're comparing annuitization versus income riders, based on how long you're trying to let it fester in there, typically as long as it's over a year, the income rider solution, even though it's giving you all that flexibility, it still could give you a much higher income payout than the annuitization option. Annuitization options typically when individual is trying to trigger income immediately, and that's known as an immediate annuity or a SPIA, a single premium immediate annuity. That's where sometimes they edge out from an income standpoint. Income play is slightly higher than one leveraging an income rider. But it definitely makes sense to look at both options and to say, okay, what are the pros, what are the cons with both of these? Which one do I feel most appropriate, for my individual situation that's going to, help me sleep better at night, knowing that I have income coming to me. But if I do have certain get out options, I could take these dollars. An example would be if you get deemed terminally ill, you want to take the money and, use some sort of, advanced cancer treatment, whatever that is. If, let's say, you have to go into a nursing home facility or assisted living facility, you could have certain get out options with the accounts that have the income riders with it. You could have long-term care doublers. So something that Medicare doesn't cover is long-term care, the activities of daily living. If you have 2.6 ADLs, activities of daily living, it could trigger a doubler. So if, let's say, you're getting $10,000 from the top option on the income rider side, it could double that, to $20,000 for up to, 5 years as an example. Or if your account balance hits $0, whatever the lesser of those two are. So there's a multitude of different things you could leverage with it. But the reason why I don't like annuitization is because it's restricting your control. It's restricting. I've worked my entire life up until this point. I want to at least make sure if I'm on my deathbed because I had some just debilitating ailment that is now making me terminally ill. I want to have this peace of mind that I saved this money, I used it properly, but I did not just give it back to the insurance company. I was able to leave it to my beneficiaries. So that's the reason why. And a lot of people, they get suckered into annuitization options, or they think that that's the only solutions available, or better yet, they'll get set up in variable annuities. The reason why I don't like variable annuities, just to kind of pile on, is it acts like a fixed index annuity with an income rider, except for your physical money could be going up or down, but the fees are enormous. So instead of an average fee from a fixed index annuity with an income rider that's averaging around 1%, variable annuities could range from 3% as high as 5-6%. So you don't only have the downside risk that if the market crashes, your account balance is going to crash, but then on top of it, you have an enormous amount of fees that are being added onto it. So if you have 4% in fees and the market grows 10%, well, simplistically speaking, you're only netting a 6% growth on your physical money because those fees basically try to drain down your account. If you're getting hit with fees and downward market risk and trying to pull out money all at the same time, it's known as reverse dollar cost averaging, has a compound interest effect against your account liquidating very quickly. And then the secondary aspect is variable annuities with income riders do not come close to the lifetime income payout that you could have with fixed index annuities with income riders. Something that's safer, that gives you much higher income and the whole purpose while you're using it. I compare variable annuities to a duck boat. It's a half boat, half car. Variable annuity is like a duck boat because it's kind of like an investment and it's an income product. Doesn't make a very good income product, doesn't make a very good investment. A duck boat doesn't make a very good car, doesn't make a very good boat, but you could obviously drive on land and you could go in the water with it. So that's why I just my analogy behind variable annuities with income riders, I just think they're horrible. So now you essentially heard my rant about, what is longevity insurance? What is some of the bad things? Now, what are some solutions? And how can you make sure that you're segmenting your retirement assets into, different intervals? And the most common ones are qualified accounts. So these are going to be your 401ks, your 403bs, your thrift savings plans, your 457 plans, based on who your employer is. If it's a private institution versus a state entity, as an example, those would be obviously more pre-tax, qualified, tax deferred related accounts. Traditional IRAs stay in that qualified status. Roth IRAs are Roth related money. So maybe you took money from a Roth 401k and you rolled it over into a Roth IRA. That's what creates the Roth. So those are known as post-tax dollars or tax-free money, gross tax-free. You can pull your monies out tax-free. And then you have your non-qualified monies. Those are going to be your savings, your checking, when you sell a house, sell a business, whatever that is. And you can use it as cash monies in there. So whenever you start nearing retirement, what's going to happen is you're going to take an inventory of what your assets are. And then what you're going to want to do is look underneath the hood and say, okay, these are my expenses right now. These are the different things that I want to do. This is what I dreamt of every day once I hit that ideal retirement date. How much does that cost? What are those expenses? What's the difference between those expenses in retirement versus your current expenses? Are you currently paying for a mortgage? And then when you actually hit retirement, you're not going to have that mortgage payment anymore. You may be just going to deal with the property taxes. What's going to be that significant difference? Is that going to drop off? Is it going to be somewhat similar? Do you want to incorporate for inflation? What the cost of goods and services are increasing each year. So there's a couple different ways to do that. The most basic way to figure out what your expenses are is you could use an acronym of MUG: mortgage, utilities, groceries. Mortgages could be rent, could be obviously your mortgage, whatever your housing related expenses are. Utilities, your cell phone bill, your cable, water, heat, whatever that is. Groceries, you could lump that into the meals every week. Whether you want to include entertainment in that, but something that would at least give you some sort of baseline to say, okay, we have to at least hit this certain area. This is our required expenses. And then you could add on to it. I want to also make sure to golf a couple times a week. I want to make sure to travel to Europe a couple times throughout the year. I want to make sure to visit my grandkids and be able to take those flights or take those times off and be able to drive to them. And it's going to cost X amount of dollars in gas. Try to get as clear as possible with what that vision is and then back up into the math. And the easiest way to utilize a longevity insurance or those types of accounts is when you understand what that inventory is, then say, okay, is my income greater than or equal to my expenses when I stop working? When I'm no longer creating that retirement, when I'm no longer creating that occupational paycheck, am I going to be receiving a type of retirement paycheck? Social Security income, pension income, which unfortunately a lot of individuals are not offered pension plans. are there any other sources of income streams that are coming to you? If there's not, then you have to get very detailed on what that gap is. Is your Social Security for both you and your spouse, is it covering what your basic expenses are? If it is, great. Then you don't have to look necessarily towards a longevity insurance play. If it's not, like most Americans, that's where you might have to add certain dollars into it. And the reason why you'd leverage longevity insurance is because you'd be able to use a lot less dollars than leaving it at risk in the market. So whenever individuals try to leverage a growth-related strategy for an income-related need, you might have something known as the 4% rule. And this is something that Morningstar just recently came out with a report in November 2023, and they doubled down on it. They said 4% is a safe withdrawal rule, that if somebody's leaving their money in the market and they have a combination of stocks and bonds, they should comfortably be able to pull out 4% and try to adjust that for inflation each year, that they should have about a 90% chance of not outliving their savings. When you use the longevity insurance, that number could be significantly higher. You could have a 100% chance of success with whatever that income is that you need to at least tailor to have some sort of baseline there. And how these insurance companies do that is by interest rate environment, their general accounts, and there's something known as mortality credits and the law of large numbers. So the easiest example, and one of the best examples I've ever heard on this, was, let's say if you have 5 women and they're all in their 80s and they decide, okay, we've all been getting together every year. What we're going to do is put $100 in a basket and we're going to bury the basket. 5 women, $100. It's $500. They all come back the next year and they said, we're going to come back the next year and we're going to spend it. Well, unfortunately, one of those women pass away. She never makes it. So now you have 4 women that are opening up the basket. What did they do? Did they invest that money? No. But now they're all splitting that money. They made a 25% increase because that one person passed away. That's, in its essence, or in very basic components, explains mortality credits. They didn't do anything. All that happened was one individual passed away. They lumped the sum of their dollars, and now, when those 4 women went back to the basket, they're now able to reap the benefits of that $500. And unfortunately, because that one woman passed away, it now increased their rate of return off of what that basket was. When you take that and you mix it with the current interest rate environment, and you mix it with years and years of data and actuarial tables that are saying pinpoint how long somebody should be living, that's how you get these sorts of income plays that are significantly higher from a cash flow perspective than you would be able to attain by leveraging growth-related dollars. Growth, it serves its purpose. By no means should you just be placing dollars towards longevity insurance. You should make sure to stagger it out properly. How much income do I need? Is there a gap there? What's the smallest dollars, only as much as necessary to close this gap? Should I use my 401k and roll that into a customized traditional IRA to do this? Should I use Roth IRA monies to do this? Should I use my non-qualified monies to do this? Should I use a combination of all 3? And that's how you could segment and stagger them out properly. Maybe you want to have a baseline income when you retire at age 65 and have lifetime income there, but then you want to also have step-ups in income at 67, at 70, at 73, at 75 to keep pace with inflation. There's different ways you could trigger at certain deferral mechanisms that could be very effective. So the ultimate goal with any sort of really retirement plan should be using the smallest dollars only as much as necessary towards your income need. Smallest amount of dollars only as much as necessary towards your emergency need, saying, I need to have a bucket in case of an oh my gosh moment was to occur. And then ultimately try to leave as much money as possible into your growth and inflationary buckets. Your ultimate goal, if somebody has $1 million accumulated and it's only going to cost them $100,000 to place it into the income related strategy and $50,000 to place into the emergency need related strategy, now they have $850,000 remaining that they could use as their fund monies. I want to use a couple, some 100,000 or so in this account for something that's dealing with the stock market and the risk with the stock market. So it's high risk, high return. I want to use another portion of dollars towards fixed rates of return, another portion of dollars towards a safe accumulation play, and make sure that now they're tailored towards specific goals, specific expenses or specific needs, so that you could live retirement with bliss, with peace and confidence. So in closing, I hope you learned a lot of different things about longevity insurance, the good, the bad, the ugly. It could be a fantastic tool based on the different types of accounts that you have. What really separates us is we're the best in the country when it comes to these things. And I say that with pure confidence. I know it probably sounds egotistical as shit, but it's just the way that, I've seen other advisory groups handle this. And if you want something to use the smallest dollars only as much as necessary into the correct areas, not place any more than what you need to, that's where you would go and reach out to us and have us explain it a little bit better. If you're interested, we are giving a free 20-minute connection call. All you would do is call our 1-800 number. You would reference this video and say, I want to speak to a specialist. You could ask to speak to me directly. And really the purpose of that is, of the connection call, is to just really see what's most important to you. Where are you right now? Where are you trying to get to? Go an inch wide and a mile deep, and tell you candidly might not work for your specific situation. A longevity insurance, it could be amazing for the right situation, and it could be a complete disaster in the wrong situation. So we just want to try to provide as much value as possible, regardless if we ever work together. If we do, have that secondary conversation, we, send personalized videos, different resources, contents, books, different things that could help your educational aspect of this. But if not, I just want you to stay tuned to some of our most recent videos. Feel free to subscribe to our YouTube channel, Retire Sharp, and feel free to reach out whenever you need. I hope you enjoyed, and thank you very much.